Hello. Hello.
Good morning. I'm sorry, I
Hi.
had my volume down.
No problem. No problem. Just wanted to know if it was working. Okay. Thank you everyone for coming. Um, really excited to be back. I really appreciate everyone showing up. It's really kind of you. Um, I'll just spend a moment to say that it's been an interesting time. I've had a bit of time to reflect. You know, in the service, there are different types of people. There are people that are more active, and there are people that are retired, and there are people that are kind of just starting to invest. Um, and how to provide value to the broad spectrum. And I kind of feel like when people start investing, they kind of like they're super excited, and it's like, yeah, it's cool. And I saw the other day, uh, someone was saying, oh, they bought this house for 400,000 in 1997, and they sold it now for a whopping 1.3 million. And I was like, wow, that's some cool numbers, man. I was like, yeah, that's pretty terrific. But that's like 4.5 compounded annual growth rate. 4.5. It's like it's not much, but it's like, when you see it like that, it's like, wow, that's like crazy. But and the same here, investing can be extremely lucrative, but it takes time. And there are like I don't know how to think about explain progress, but when you go to a resort or whatever, and you return the following year, and there's like little adjustments, like the pavement has been broadened, or there's like small little things that happen, and then you don't go back to that place for like many years, and you return like several years later, and it's like much greener, and it's more pedestrianized, and it's like, wow, like it looks so much better. But it took time. And going back to my service, I kind of, a lot of people come to the service, and they kind of they're very active at the start, but after 2 3 weeks, or like a couple of months, people are kind of bored. They want jazz. And I see that, for example, during the earnings season, people are really excited. So the long and short of it is that I'm going to start emphasizing to people a bit more that the majority of what I do you can ignore, literally, like you can ignore. But when I put in the email in block capitals trade alert, that's the only time you need to do anything, right? You need to kind of say, okay, Michael is either recommending a new stock, or recommending to sell a stock. And that's it. Because, last week when stocks kind of went a bit, it was a bit of a brutal sell off last week. People were like, oh, has XYZ changed? But no, like, from my style of investing, it's really about the holding period. That's really, and it's not exciting, I can't, but I try and say that 12 months isn't, it goes fast, it goes fast. And if you think about it like, okay, I can't do anything, I'm locked in here for 12 months, you'll be much more selective where you get involved with. That's like right away really important. But B, you understand a lot more that this is a business. And in the business, businesses don't move around that much. And that helps takes some emotions out of investing. And I think that's really helpful because, when stocks kind of go in a sell-off period, kind of people want to react. What shall I do? Shall I buy? Shall I hold? Shall I sell? And no, you don't need to do a whole lot, right? The majority of the time, you don't need to do anything. And if you're following my service, I will tell you, you know, do something now. But in the vast majority of cases, you just have to sit on your hands. And yeah, but on the other side of the equation, I do a lot of the heavy lifting. And I believe I deliver 15% compounded annual growth rate. So when we referred before that 4.5, like, and you saw how that works. Now, I'm not expecting anyone to believe into me and to buy into me for 30 years. I get that. But my point is, over a 2-year period, that kind of starts to become interesting. And it's worthwhile admitting the possibility that the strategy works. That's all I'm saying. I'm saying that it's worthwhile. It doesn't work every single month, and there are periods, and it's brutal. And I've tried my best to explain to people that small cap investing is brutal. But you can, I don't know if anyone on this call actually follows this. I spent a bit of time thinking about this. So some of you will probably know, large caps are doing really, really well, but the small caps have been brutal. But it's not always brutal, and that's really the thing. It's not always like this, and there will be a period where the small caps catch up a little bit with those mega caps, and you'll see them. They'll sizzle, and all that time is like a little coiled spring, and all that time that it's not doing anything, it will just move really fast, and you can get some real jazz on those periods. The thing is that you have to wait a bit for them to happen. So in investing, I believe that there are, some things you can control and some things you cannot control. You can control the business that you buy into. You can control the price you pay, the valuation price. You can control how much of your portfolio you put. So there are 3 things you can control. What you cannot control is the price you sell at, okay? Now, even though there's really no control on that side of the equation of the price you sell, there are some things you can do that put the odds slightly better in your favor, okay? First and foremost, be really selective, okay? You gotta just don't buy just anything that is moving, okay? Be selective. This is really, really important. And people always say, oh, because they know I look at a lot of companies. Oh, what do you think of this? What do you think of that? It's like most of the time, 99% of the time, I think it's not going to work for me. So you got to really, really selective. The second thing is valuation matters. The price that you're getting involved with matters. Okay. So for example, I'll reference this because people like it when I give an example. I've been talking a lot about theory, but it's helpful when we kind of put some context around this. So I know that CrowdStrike is an amazing business. I know that. The market knows that. Everyone knows that. And it's an amazing business, highly profitable, but there's a point in time where the risk reward isn't really that exciting. So that's why I went to Sentinel-1. So Sentinel-1, I know it has a lot of hairs on it. That predominantly the hair is that is really unprofitable. But it's not always going to be unprofitable. That's the first thing. The second thing is that you don't need to be a hero when it comes to investing. You just kind of look out 12 months. If it makes sense, looking out to next year, look further. If it doesn't make sense looking out to next year, don't bother. And I don't believe in using like discounted cash flow analysis and all this kind of stuff, because you can crunch whatever numbers you want. But those numbers, extrapolating what it's going to be in year 5, it's nonsense, okay? And to give an example of how it's nonsense, I saw the other day a tweet, and it showed like it was a newspaper from around 2001 or something like that. The newspaper said, "Oh, the internet is going to be just a passing fad." Now, obviously, we know the internet didn't turn out to be a passing fad, but the butt of the joke was that was a newspaper, and newspapers today are the passing fad. So it goes to show that sometimes extrapolating into the future is really, really tricky. So you don't need to kind of extrapolate the next quarter, but you need to have a bit of sense of what it looks like next year. And if it seems to be progressing towards being more free cash flow generative, making more profits, then you say, okay, that's interesting. And then you do step 2. Step 2, you just spend 5 minutes and you look at the balance sheet. If the business needs a lot of debt to grow, that's tricky, okay? That's tricky. But if the business has a lot of cash, well, that's interesting. And if the business has a lot of cash and no debt, like in SentinelOne's case, hey, the business can do quite well for some time without actually needing to turn a profit. They can work on their innovation, they can work on expanding their workforce, they can work on different things to take market share. Possibly from CrowdStrike, you don't know. But my point is that if you just think a little bit about what kind of valuation you're getting involved with. And this takes me to the other point, that in the market, at times, there are certain things that get rewarded really well. Okay, so for the majority of 2023 and into 2024, semiconductor companies were like red hot. Oh, everyone's like super excited. But you don't know when that super excitement is going to wear off. So you can have, I don't know, but a person may have some NVIDIA, but don't go by the whole like NVIDIA, AMD, like Broadcom, blah, blah, like pick out one company that has exposure to that aspect of the economy. And then don't do something else. So for example, at periods of times, software companies, like everyone's like, oh, you need so much software enterprise. Oh, like I get it, right? So there is a secular transition towards a digital only world, but secular transition doesn't mean that it's going up in a straight line. It goes through a cycle, okay? So it goes up, comes down, comes up, goes down. So don't just buy an exposure to what's working right now, because that is really, really difficult to do and to do well. And I don't know of in my time of anyone that has succeed. I've read a lot of books about investors, traders, whatever the hell, and I don't know of anyone that succeeded in that type of approach. So, and a lot of investors kind of new to investing, oh, this is working and it's going up to the right, and they want to get like exposed to that. Like, think about it. You need to be doing like a yin and a yang with the market. You can't always be buying what's in favor right now, because at some point, that's going to take a contraction, or it's going to, it's going to correct somewhat, right? Because the markets move in fits and starts. It's not a straight line ever. So it's really important to be mindful of what you're getting involved with. You don't want to have too many stocks. I don't believe that having, let's say, 30 stocks in the portfolio is helpful, because you don't know what you want. You don't know, okay? You know the tickers, you know the stories, but stories change quite a lot. And if you're not kind of on it, and if you haven't got a team of people, they just become like, oh, so and so said this about my company, and it becomes a familiarity thesis rather than you just actually looking at the numbers and say, does this actually make sense? Now, I'm kind of waffling on. I just wanted to I got just two more points I wanted to talk about. So I believe that as an inflection investor, the lucrative part of investing is getting the multiple that you're going to try to sell at. Now, let me caveat that immediately. Nobody can control what multiples will be next year. Okay, nobody can control that. But you can have some experience. And again, as I said before, it's annoying, but experience is built over time. You need to go through a business cycle, 6, 8 years to kind of understand, okay, multiples change. And what is being rewarded with a certain multiple now isn't necessarily going to be rewarded with this similar kind of multiple next year. But if you're thinking about the multiple, you're actively trying to be conservative in thinking about what kind of interest investors will have in that free cash flow next year. So that's getting that right comes from experience. But if you get it right, it can be really, really rewarding. Also, importantly, it gives you conviction to hold, because I don't believe that the money is made in the buying and the selling. I mean, it's made in the sitting on your hands. And it doesn't seem that exciting, but at the end of 2024, when we come and look at how the portfolio is done, like, oh, you know what, like we've done X amount of percent, and it's like, oh, okay, it didn't actually, it was kind of worth it. And I think a lot about that. Will I reach the targets that I want to reach? Will I deliver for you? And I think about, how to provide value so that it's a person can, defer the heavy lifting to me, but also have trust that I'm active and I'm watching and I'm managing the portfolio. Now, I just wanted to highlight one final thing. So it's important that you recognize that we're going into earnings season, and it's important to recognize that when it comes to selling a position in your portfolio, you are never going to get out of the peak. So if something looks kind of fairly valued, it's okay to say, hey, I'm going to step off here. I'm going to park this as cash. And then we'll see in 3 or 4 weeks what opens up as a new opportunity. The market can shift quite quickly in 2 or 3 weeks. It can look like nothing is really happening, and then all of a sudden things are happening. So as we progress towards earnings season, I will caution people to think about that it's not about trying to get out of the top. Think about it's okay at times to park an investment into cash, because cash is really, I say this all the time, cash is like oxygen and no one cares about it. But when you really need it and you got like that shortness of breath, like you really need it. And it can really, really provide a lot of margin and safety to your portfolio. So that's what I wanted to talk about. I welcome some questions if anyone wants to ask any questions. This is a good time.
Good afternoon, Michael. I missed the first 3 minutes, so I might have missed what you said, but I was curious what your thoughts are on Sentinel-1 because of what happened with CrowdStrike. Did I miss the whole conversation?
No, well, yeah, I did talk about it, but I didn't say anything profound. I said that I think that it's not, well, I didn't really address this, but this is on the back of my mind. I don't believe that the impact from CrowdStrike will affect SentinelOne now. I don't think it's going to affect it this quarter, although the market is reacting to it. The market is reacting, but I believe that it's not going to happen right now. What I believe will start to impact is later on into early next year. And the reason for that is because when you taking on a new cybersecurity company, it takes time. There's a sales cycle. You need to test it. You need to deploy engineers. It's not the kind of thing that happens next quarter. So I believe that there's going to be a bit of a transition away from CrowdStrike into SentinelOne, but I don't think it's going to be anything that's happening like now, next quarter. These things take time. People are locked in to CrowdStrike for many years. So it's not the kind of thing that I will believe will see immediate impact. For me, the thesis on CrowdStrike is the same as it's been. I believe that they will make, by the end of next year, they'll be on a run rate. A run rate means an annualized figure. It's an estimate. And a run rate of about 100 million of free cash flow. So you'll go from where it is right now, which is kind of burning about 150 million, more or less. If you look at Q1, how they did, they were burning at that point approximately 150. I believe that when they report, because they're they're cybersecurity company, so they're right at the end of the earnings season. But so I believe that when they report, they'll be maybe around negative, let's say 50, maybe negative 30, but you'll see a progression. And I've had this thesis for a while, even for the CrowdStrike thing, that they'll reach break even by the end of this fiscal year. So their fiscal year and the calendar year misaligned. So I believe that they'll reach break even then. And if you, from today, you look forward to next year, they'll be close to making 100 million of free cash flow. So you'll see a business that is growing at about 30%. But what is really important here is two things. Number one, the narrative is going to change. Okay, it's not going to be, oh, this unprofitable dog. It's going to be like, oh, there's another CrowdStrike. That's the first thing. Narratives are really important in the market. And I came up with this kind of this phrase or this saying that a grain of truth in the market very quickly turns into a belief. And from a belief, it becomes a hard truth. So narratives carry the sentiment, the first thing. The second thing is that their comparables, their growth rate comparables, are going to start to dramatically improve starting now, this quarter. So when they report now, from now until the next 4 quarters, the comparables start to become really, really easy. So it will take no difficulty for them to reach a 30% compounded annual growth rate. So you're going to have a business that's profitable, growing at 30% with $1 billion in revenues. Now, I think there are, I know of 4 companies that are growing at 30%. They have $1 billion in revenues. One of them is Samsara. The other one is CrowdStrike. The other one will be SentinelOne. And I think at some point soon, Hims and Hers will be there. So generally growing at, like, if you have $1 billion in revenue and you're growing at 30%, that's really growing at scale. And that's what investors love. Investors love a business that's stable, a large business that's well-tested, mature, and with strong growth and highly profitable. And that's everything that, not now, but next year, SentinelOne will be seen as. But you have to always be 12 months ahead of the market. You have to be. The market's always looking forward 6 months. You always have to be looking 12. So you have to think about, like, be very, very focused on what's going to happen next year. And yeah, that's my long and short on SentinelOne. I'm happy if you have any other questions that you'd like to ask about SentinelOne. It's a company that I've been very bullish on for some time. I like this company very much. CEO is really young guy. I think it's 41 years old. Is yeah, it's quite interesting to, because to be a CEO of such a entrepreneurial company at such a young age is like really, really cool. Yeah. So I'm hoping that, he's highly motivated, he's young, he has a lot of skin in the game. Yeah, I'm really excited for Sentinel-1. Let's see how it goes. Yeah. But I'm happy to take any other questions you have about Sentinel-1.
Michael, is there any stocks that you are considering to release, as in, you're close to making an announcement?
Yeah, definitely. Two, I want to get rid of Palantir. I'm waiting for that day to hit 30. I'm really hoping it's so close. Palantir, like, I'm really, really hopeful. Number two, I'm hoping to get rid of Alsta as soon as it reaches $17. I'm slightly behind that. I'm hoping that Robinhood is going to hit $30, but that's around $24 right now. So it's kind of still needs a bit more. So those are the three that I'm going to sell. I have a new stock lined up that I'm ready. I am like ready to go, but I really need to get rid of something in the portfolio. I don't want to have more than 20 stocks in the portfolio. I think it's really, really important, this number 20, because when you have small caps, as you saw last week, right? You saw George last week. It can be brutal, but when it's a market-wide sell-off, it's not the big deal. But when a small cap has something specifically wrong with it and it comes down quite quickly, if you have 20 stocks in the portfolio, you're talking about like a 5% position. So, it's not a killer. That's really what this game is about. It's right about surviving and get, how to explain it. When you like playing amateur tennis, I've only played it a few times. I'm really, really rubbish. But it's just like, you're just running around trying to kind of throw that ball to the other side of the court. This is what investing is just surviving, like working on surviving. And I think that having 20 stocks in the portfolio works because it's like that, it gives you time to survive. Being more concentrated, being more concentrated definitely drives stronger returns. But the game is not to go from zero to hero. The game is to stay with it, to survive. So I strongly believe that I will deliver through the cycle 15%. I strongly believe that. But I know that in some months it can be really brutal. So if I can't take you on my journey with me, I could have 10 stocks in my portfolio and it'd be really volatile, and I'd be happy that because I know those businesses. I'm comfortable with my experience, but I can't take you with it. And that's, yeah.
Can I give you another follow-up to that?
Yeah, please do.
Would you I want to ask you, would you want to let us know what those are that we could, maybe do a little look into before you announce that? What could you tell us?
Yeah, sure, go on. So the one that I have that I'm ready to go is it's you see, I'm always kind of apprehensive of recommending international companies because my subscriber base is US, so they kind of relate more to this. The company is called Coupang. It's north. It's like it's like the Amazon of Korea. So it's CPNG. CPNG. Coupang. That's a ticker. The reason why I think that Coupang is really attractive is that they have the main business, which is like Amazon, but then they have this kind of other segment. They call it developing segment. It's a business unit that makes up about 9% of the overall Coupang. What it is, in fact, is a bit like a venture capital kind of business, but the majority of that is like Uber Eats. So you got Coupang, and within Coupang, you have this kind of Uber Eats that makes up the bulk of this 9% of total revenues. But this 9% of total revenues, I believe, is growing at about 100% growth rate. So this, again, is, always echoes everything back to the start. this time next year, I'm always thinking about what's going to be next year. So if that's growing about 100%, this time next year, it'll probably be approaching 20% of Coupang, okay? And at that point, people were like, oh my God, Coupang has actually got some growth. It's not just like an e-commerce business, it's actually got something else, right? So that's really important. Number two, everything that I told you about Coupang and this Uber Eats, just put that aside for a second. Within this e-commerce business, it's growing at about 18 to 20%. So it's got some growth there, okay? It's profitable. And that business is priced at 16 times EBITDA. That's really quite cheap. It's really quite cheap because you're getting for free this Uber Eats. So you get the e-commerce business at 16 times EBITDA, and you have the really fast growing Uber Eats with other things in there. They got some other stuff as well, some other kind of delivery services and other stuff happening there. But I like that. Number three, I think that for me personally, I have found when the founder is still running the business, they tend to be quite aggressive because it's their baby. And for me, this is kind of another thing that I like when the founder has a lot of skin in the game. They're highly motivated. So that's another thing. So with Coupang. Also, I have discussed this on numerous occasions. Having a really strong balance sheet is really important for me because that gives you stuff to do. Coupang acquired Farfetch. That we've discussed this Farfetch many times, you and I. Acquired Farfetch out of bankruptcy. So they acquired it and they are going to start doing some kind of luxury e-commerce website as well because they've acquired Farfetch. But when you acquire a business, you have to kind of get rid of some services, this and that, some overhead. So there's a bit of a period, let's say 6 months to a year, where you have some restructuring. So you're not as profitable as you could be. But again, what I said before, look out to next year, and I think that they're going to be more profitable and bigger. So you can have Uber Eats, you can have this kind of like luxury marketplace that sell fashion items like Farfetch, and then you're going to have this e-commerce business. So it's going to be a more diversified business. I think that's really, really exciting and attractive. So this is the business that I kind of I haven't told anyone. This is like I'm like saying it for the first time. I generally don't like to kind of pre-announce things. I like to kind of explain to people, give them the time of the day to explain it. But yeah, so I'm looking at Coupang. There is another one that I'm kind of looking, but I'm not ready to disclose that one quite yet. So yeah, that's what I'm thinking about.
Thank you, Michael. And sorry to get that out of you if you didn't
No,
want
that's
that.
fine. That's fine. George, man, you're the man. Like whatever.
Okay, thank you.
Thank you. Yeah.
Hey,
Did anyone
Michael,
else
it's
have any
Daniel
questions?
here.
Hi, Dan.
I
Hello.
had a question just about Ouster because I feel like that holding period was a bit shorter. Is
Yeah.
that right?
Yeah, man. It was very short.
Yeah. Was
So
that kind of the surprise to you that it's going up that fast,
yeah,
or more like
yeah,
here's your target and then
yeah,
like you're here?
yeah. So in my experience, I prefer to not keep raising the price target. I prefer to, once it hits the price target, to try and exit. So sometimes it hits it really quickly. So early this year, I had this business called Celestica, CLS, the kind of a cooling company for data centers. They will kind of, I recommend this business, and it was up like 45% in like less than 3 months. So I was like, okay, it's hit my target, and it was supposed to be like a company that was like relatively low growth. It was supposed to be kind of a quote unquote hedge for my kind of higher growth names. So going back to Ouster, I kind of felt okay that I was willing to wait 18 months for it to go up about 50%. And I feel like if I'm going to get that like so quickly, I can find something else that is undervalued. I have no difficulty finding stuff that is undervalued. And you have to be quite, careful in the market not to overstay your welcome. So you always have to kind of be recycling these names. That's the disadvantage of my strategy. The disadvantage that sometimes these things kind of work up quite quickly, and you have to be kind of like, oh, I kind of like this business, I like the management, I like the story, but you can't like, and it's really unpopular. And I know that, I know that is like, I know it's bitter. Like you kind of recommend something, it works, people excited, and it's like, oh, now I'm going to sell it. And I know that. But you have to be really careful in the market, man. You have to be really, really careful because these things go really quickly. These things blow up like really quickly. So
And you see this as kind of transient. You don't want to revise to above 20. You're like, okay, 17, we're good.
So a lot of people have asked me this question, and I've, I know that sector isn't performing very well. Robotics, I know, I've seen it. I know enough of their players. So I think the market is getting a bit carried away here.
Okay.
If everyone in the sector is doing well, then it's okay. We're cool, But if everyone in the sector is dying and this small cap is doing well, I don't know, man. You and I discussed this before about the risk reward. You always have to be thinking like how is it going to be, And the thing that I'd hate, I've done okay in this stock, and the thing I'd hate is for it to blow up on me. Because when a position grows, it becomes a big portion of your portfolio, and it's like when that blows up, it kind of like, man, it like drags everything down. You know what I mean? And it's better to be safe than sorry.
No, I really appreciate that because I think when you recommended it, I think I had looked and it was like I had gained 40% on it. Like, so it was like that's a fantastic return in like a matter of several months. So I was just curious, like, and I really appreciate that perspective because that in my lay perspective or less experience, I'm like, oh, I should hold on to this. But like really, I
know.
totally
Listen,
can see where
the saying is hold on to your winners. I know that. Okay. But hold on to your winners. These kind of, for every saying in the market, there's an opposite saying, right? And this is a small, untested business. Okay. It's not like a very well established business. And if the rest of the sector is on its knees, I'm like, oh God, I don't know, man. It could work out, and it would kill me, and it happens, But you can't think about the emotions of investing.
Yeah.
You it's a game of odds, and if I don't feel like it's like when I recommend something and I say to people, okay, I'm happy to increase the price target. Me, Michael, I need to be confident to underwrite it for another year. I need to say, okay, I'm recommending to somebody, I have a responsibility to somebody else, okay, to stay with it for a year, because I eat my own cooking. And do I want that responsibility of another year? I don't know, man. It'll be like, Michael, the whole sector was blowing up. Why did you do that? And that's the thing I was saying before. Try and avoid these kind of repeating rookie mistakes.
Yeah. No, that's great. Thank you.
Okay. I thank everyone for their time. Thank you so much. Really nice to see everyone, and hopefully see you next week. Yeah. Thank you, everyone. Bye-bye.
Thank you, Michael.
Thank you so much.
Thank you very much.